Dhirendra Kumar from Value Research to give us a list of names wherein there is a lesser commission structure and really, emphasize, Dhirendra, morning firstly, on the fact that it may not pinch you in the shorter term, but, like Buffett quoted as an example in his newsletter over the weekend, over a time horizon of 15, 20, 30 years, this adds up to a lot of money, the commission that you pay on the mutual funds.
Yes, that is actually the expense ratio, and over and above, even in the underlying, if a fund has higher turnover, that does not even show up. In fact, mutual fund with high turnover might be incurring cost which you will never be able to figure out. So those are the hidden costs. If a fund has 200% turnover, you'll be incurring a cost which you don't know. And that all is a drag on the performance, because everything remaining the same, expense matters. And so talking of expense, mutual funds in India have been very impressive. Despite high expenses, they have been able to beat the benchmark by a wide margin, which has not been the case in the US, where 90% of the fund on a long-term basis, on a 5-year, 10-year, 15-year, 20-year basis period, they are unable to beat the benchmark by a meaningful margin. In India, it has been the reverse. 80-90% of the funds beat the benchmark. But that is coming, I'm doubtful that that will continue to be in the future. The first symptoms are very much clearly visible, more so in 2018, when we saw that most large cap funds struggled to beat the benchmark. And narrowness of the market is being attributed to it. But I think the fundamental driver has been expense. If you have a mutual fund with 2.5% expense, then the benchmark, you have to beat the benchmark by 2.5% first to match the benchmark, and then comes the alpha, then comes the extra return. And in a narrow the set of stocks, the large cap universe, top 100, top 50, top 60 stocks, it is very hard to add value, deliver extra return, and extra return will come only by assuming extra risk, some degree of concentration, and that may not work out always. It may not work out nicely many a times. So and that can add great deal of turbulence. So I would say that expense matters. Be very sensitive to it. But I think in India we are making major headway in that direction. Expense ratios have come down. Entry, upfront commission has been completely abolished. But all these things are going to be implemented from 1st of April 2019. So mutual fund expenses are definitely going to come down substantially. And more importantly, the abolition of upfront commission is going to be a very significant driver of the, it is going to influence the behavior of all the intermediaries. And this is, I think, global first in terms of aligning investors and intermediaries' interests.
Right. Dhirendra, just to take off from what Aisha was saying, and, Warren Buffett made a very interesting observation that back in, 60 years ago or so, if he had put in money in index funds vis-a-vis in gold, the kind of returns he would have made would have been incomparable or phenomenal. Let's talk about index funds back home. No doubt the fact that it has a low expense ratio versus other funds is a USP, is what makes it stand out. But other than that, you have gone on to say that it doesn't have a very compelling case for investment in India. Why do you think that is?
Simply because, our index are not very, one is that we don't have broad-based index. When he's talking of index or the largest index in the index fund in the world, we are talking of S&P 500. So it's more diverse index. In India, we don't have those index. Our markets are very narrow. They are very shallow. So that's one. Then at a certain level, the underlying efficiency of the underlying businesses are just as important. When we talk of S&P 500, they are made up of globally competitive businesses built in a very competitive environment of free market. Whereas in India, our markets are not free. Our markets are not, all the segments of the economy are not publicly listed and traded. That's another. Third is that at a certain level, indexing becomes a self-fulfilling, virtuous cycle. In a way that if you have a lot of pension funds, if you have a lot of money getting into index funds, then index funds itself, that itself becomes a driver. More you get more money, more index, index stocks get driven by that. So in that sense, large proportion of money flowing into index fund itself sustains the index. And we are beginning to see some of those variables falling in place. In India, in the last 3.5 years, we saw the emergence of India's largest fund, equity fund, is Nifty ETF. This has become 45,000 crore fund, close to the approximately, and that is entirely, it can be attributed to employee provident fund contributing its, making its investments there. So if we have mandatory savings flowing into equity, and those money, because institutional institutional money generally finds index attractive, because they don't have anybody to blame for underperformance or outperformance, and they are able to account for it far more efficiently. So that way, I think NPS money, EPF, employee provident fund money flowing into index fund itself is a driver. But I don't think the reason why index funds have not taken off in India in the last 20 years, because actively managed funds have delivered superior return despite high expenses. Expenses might come down and index funds might have a stronger case in future, but we still have to, the jury is still out. I will still wait for a couple of years, because we don't have the index vehicles to invest in a multi-cap, in all the segments of the market, in the small cap segment of the market, where I find that, magic happens in India.
We were still in conversation with Dhirendra Kumar and still trying to analyze the case for whether or not index funds with a low cost expense ratio do make for a good investment bet in the longer term horizon. Dhirendra, so welcome back. And you before the break, you were just making the point that India still doesn't have that matured kind of market which does give you a good exposure, a balanced one, multi-cap exposure in any of the index funds. But say suppose someone is looking at a time horizon from today to the next 20-25 years. I'm assuming up until then at least we would have many options. So would you say reserve your investment for the next 5 to 10 years and then perhaps take a look, and for now go with a balanced or a multi-cap fund?
Oh yes, in fact, your your fund selection or where you are invested is going to be a very small contributor to your being well off, as compared to if one shouldn't be waiting. One should definitely be getting started with a balanced fund. In a couple of years, one should definitely be moving his money to a multi-cap fund. If you are able to save just 15 lakh, 1.5 lakh rupees in a year, and you have to invest for saving taxes, go with your multi-cap tax saving fund. It is only at a future time when, if index funds they present a compelling case. Most funds are unable to beat the index in a 5-year time frame. Surely then it actually makes sense, and that is the time when one should move all one's allocation to that and have a peaceful life as well, because then you will be assured of at least matching the benchmark, not beating the benchmark, not underperforming the benchmark. And but I feel that this whole Indian play as of now, we don't have the alternatives, we don't have those options, we don't have many segments of the market for which we can mount a credible index on which one can run an index fund. That apart, I think in India the index getting created is primarily is a very sketchy academic exercise of trying to gauge the mood of the market, rather than rather than devising an index on which large amount of investment can be made. So we don't have a credible ground for creating those index funds.
Right. Okay. So, Dhirendra, what exactly is your outlook then on the current? I know you're not very gung-ho on index funds at a time like this. You're talking about how there are much better opportunities in the market. But if one had to choose, among the lot, the kind of index funds that we have in India, although we don't have an option like the S&P 500 overseas, would you have any preferences?
No, if one has to actually build a portfolio with index fund, we have limited option, but they are available. For example, if one is able to mix the SBI's Nifty ETF, which is the lowest cost index fund available, it costs actually 10 basis point. It is virtually coming for free. So, if I have to put assuming that I'm putting, 100 rupees, and I want to put this money for next 5 years, and I'm convinced that, if I have to build it only with index fund, I will put my 50 rupees there. I will put my remaining 25 rupees in the junior Nifty. That is a fund which is getting you the below, the next 50 companies, and that has worked out very nicely. And we have two funds which offer an open-end fund option. And the remaining 25% I'll put it in Nasdaq 100 ETF. So that gets me the US exposure and the high-tech exposure, maybe higher growth at a reasonable value. And this way I will be assured of, matching the index at possibly the lowest cost as well. And I don't think these returns will be very disappointing. They will this kind of portfolio, I'll be assured of what I'm getting, and a combination of this kind can well make it into a fairly, I would say that this combination can well be in the top quartile of the multi-cap category as well.
Dhirendra, thanks so much for joining us on the show today. Great to get your perspective on those funds and the best way to go about your investments there.